Hey everybody, Frank Finance here. Hope you're having a wonderful day. Today we're going to be doing a stock analysis on Marathon Oil, ticker symbol MRO. For today's agenda, I'm going to give my price target. We're going to look at 2021 Q3 results. Next, I'm going to do a brief business description, look at the stock price history and its price performance versus its peers, look at the fundamentals and financials of Marathon Oil, look at oil prices and how they affect the stock price moving forward, look at dividend information and any what that would look like moving forward. And lastly, I'm going to give my thoughts and any considerations about Marathon Oil. If you like this type of content, please consider subscribing. Hit that thumbs up button if you like anything throughout the video. Now back to your content. All right, my price target for Marathon Oil is $19 to $20 in the next 12 months. This indicates a 13.5% to 19.5% upside. So let's talk about why this price target is what it is. All right, looking at Q3 2021 results, this was reported on November 3rd. Looking at earnings per share, that was reported at 39 cents a share, compared to analyst at 31 cents. So they beat by 8 cents there, or about 25%. So a really nice beat on the earnings per share side. On revenue, they also beat earnings by $144 million. The analyst had them at 1.3 billion and they reported 1.45 billion, or about 11% beat on revenue. Another good beat there. All right, jumping to the highlights for Q3 of 2021, they had free cash flow generation of 478 million. Total for the year is at 1.3 billion. So really just real quick note here, 1.3 billion. Their current market cap is 13. So just on the first 3 quarters, they've been able to produce their price to free cash flow for just 3 quarters is 10 times. So that's pretty good. So if you extrapolate that out, it's probably going to be closer to 7 times free cash flow is their price right now. Committed capital discipline, no change to the CapEx budget. Third quarter equivalent, no increase to oil production guidance. Total 2021 debt reduction of 1.4 billion. Raised quarterly dividend to 6 cents a share from 5 cents. So very good there. Executed 20 million share repurchases since October 1st, and targeting approximately 500 million in total share repurchases during the fourth quarter. Fourth quarter return capital to equity holders exclusive of base dividends and share purchase so basically returned 40% of free cash flow to the shareholders, and the board of directors approved a increase in their share repurchase of up to 2.5 billion. Real quick note about these share repurchases. Those are super powerful, especially if you're looking at $2.5 billion over their current market cap of 13. You're looking at nearly 20% of its current shares could be repurchased through that authorization. Now, a little bit more detail, they said they use approximately 500 million in the next quarter during Q4. So that's about 4% of their current shares outstanding that they could buy at today's prices. So this is pretty good from a shares outstanding perspective. We'll go a little bit more into that in their history over time, but it is good to see that they're, delivering shareholder value by at least bringing and reducing the number of shares outstanding. All right, next up for a business description of Marathon Oil, there's 3 main segments in the oil industry: upstream, midstream, and downstream. Marathon Oil focuses in upstream with mainly doing exploration and production of oil. All right, geographically, Marathon Oil focuses on U.S. oil plays. One of the biggest, 2 biggest is Eagle Ford and Permian. There's Stack and Scoop, and then there's Bakken up in Montana and North Dakota. This is also a good play as well. All right, jumping into the stock price history. Over the last 5 years before the pandemic, really Marathon Oil had jumped between $10 and $23, mainly staying in the $15 to $12 range. During the pandemic, it dropped all the way down to almost $3 at one point. This is where I really first started paying attention, and I bought, I think, around $3 and 30 cents, $3.20. And I bought several plays up until the $4 range, and I sold my whole position in Marathon around $7 or $8 at this point in June of 2020, sometime around there. And shortly after it dropped back down, I started buying into the name. I think I bought at like 6, 5, and then I bought a bigger lot as it got back down into the $4 range. I don't think I ever bought again in the $3. I think my cost basis is somewhere in the $5 range right now. And since then, and since October, when vaccine news came out, reopening started happening, it's just really been on a tear, up almost 2x since, really tripled in price since then. So it's done really well. It's been a really good one for me. I think the thing you really have to do here is ask yourself from a history perspective, going out to the max, where is this going to fall? It's been all the way up as high as $40 when we're looking back at oil prices being as high as $100 back in 2014. And it's, when oil prices dropped, it dropped back down to where it's trading right now. And over the last 5 years, 6 years, oil prices have been relatively cheap. They've actually, they were oil at a gas pump was like getting into close to $4 in Texas, which is pretty high. I know that's not that high in California, but here in Texas it's pretty expensive. And it dropped during the pandemic all the way down to like $1.50, $1.60, $1.80. And it's taken some time to recover back to what it was. Actually, it's gone higher than what it was pre-pandemic at this point. And so oil prices are really not in a very stable place right now. They have been rising over as expected, as I think oil prices are going to get to $100 at some point if they keep staying on track to where they're at. Current prices are around $80, which historically, especially in the last 5 years, is a very high price. So what that's going to look like in the near future, we'll talk about that a little bit later. But oil prices will factor into that. So just remember, oil prices were pretty high between 2010 to 2014. They dropped, and they were pretty low between 2015, 2016, and 2020, or the beginning of 2020, right? So just keep that in mind. This is going to fluctuate the value of the stock with how much oil is selling for, as they are in the production industry. When oil takes a hit, people stop producing as much. They don't produce as many barrels of oil because it's less profitable. And sometimes it costs more, and this was true during the pandemic. It costs more to produce the oil than it is to sell it. So at some point, you have to stop production. You're going to take a loss because you have overhead, you have things that you just can't stop doing. Otherwise, it's more expensive to continue moving forward once things do normalize. So over the pandemic, they had some struggles. Just keep in mind that this stock price right now has been definitely in an uptrend. There's nothing to say that it's not going to continue that uptrend for a little bit longer. And we'll just have to continue monitoring. Right now, definitely still on the uptrend. All right, for today's price performance versus peers, we have MRO in gray, Oxy Petroleum in blue, Devon Energy in yellow. Purple is XOM, much larger company, but wanted to show a fully integrated oil company in comparison. And then the SPY, the S&P 500, is in green. Now, if we start at the 10-year mark, we can see the SP is up 271 over 10 years. And all the oil companies are down. The best has been XOM, which is an integrated oil, but you can tell that all the other upstream businesses have done relatively worse, Oxy being the worst amongst them. If we bring that down into the 5-year mark, we only one has actually gotten above where they were 5 years ago, that being Marathon. The others still down quite a bit in the last 5 years. Bringing that down into the 2-year, we can see that Devon Energy is actually up over the 2-year mark, up 87%. Marathon's up 37%, pretty close to the SPY, so that's pretty good. We have XOM and Oxy down, still not breaking even over that period. Now, if we look at the year, now this is where oil has definitely been able to outperform the SPY over the course of 1 year, right? So how long do we expect that trend to last? That is the question you have to ask yourself. Now, this performance does not include dividends, okay? So this is all capital appreciation, so just keep that in mind. I get comments on that all the time. This is only capital appreciation, doesn't account for any dividend distributions. So if we look at SPY over the last year, it's up 27%, which is very good return over a 1 year period. And we have Devon up 240, Marathon Oil up 205%, Oxy at 152%, and XOM underperforming those guys by 68%. Still a good, and I actually own XOM as well. And so when you're looking over that 1 year mark, you start to see kind of all of the upstream businesses start to outperform and do much better than the fully integrated as well as the SPY. And this has a lot to do with oil prices. You can see that this has just spiked over the last 3-4 months, and it just continues, and they just continue to keep rocking and rolling, and they've been very variable with oil prices. So I expect that trend to continue moving forward. It just goes to show you that they're performing just in line with their competitors. Devon and Oxy are slightly larger, I think maybe 2 to 3 times in market cap size, just to give us a comparison, but they are in the same industry. All right, jumping to the financials for Marathon Oil. Looking at revenue, over 2018, they had $6 billion in revenue. 2019, 5.1, and for 2020, big decline there of 39% to 3.1. Over the last 12 months, they're at $4.7 billion, and it's looking for full year 2021. They're going to be right around 5.1 or 5.2 billion. So they're going to be right around where they were to end fiscal year 2019, which is a good sign that they're pretty much going to fully recover from basically going back to where they were pre-pandemic, which is great to see. Now, looking at it on a more granular basis on the quarterly side, we can compare the Q3 of 2021 going back to Q3 of 2019 of 1.25 billion. Let's look at their net income of 165. And you can see net income 165 to 184. So they did better on the net income side, and they also did better by about 200 million on the revenue side. So, when we're comparing these numbers back, the reason why we compare these numbers back to 2019 is because 2020 is really just kind of hard to compare it. You see these incredible growth rates from a quarter-over-quarter basis, but they're pretty deceptive because they don't actually show you what they really should be compared to as compared to something that's normal. It's easy to show growth when you just got beat up and you reported, 50% negative growth the year prior. So it's better to look back on, 2 years rather than look back the year before and say, oh, look how good we're doing. Now, let's look at back what the baseline was, not what makes your numbers look good. So overall, they are going back to where they were in 2019. It looks good on that side. All right, bounce on over to the balance sheet. If we look for total cash and short-term investments, we're looking at 485. Cash is at 485. Look at total current assets. We're at 1.5 billion. Total assets at 17 billion. Most of that being in, net property and plant and equipment. And then if we go down here to accounts payable, we'll look at total current liabilities at 1.6. Total current assets are right around that point. And if we look at long-term debt is at 3.9 billion. Total liabilities at 6.3. So in comparison to total assets versus total liabilities, that's not terrible. 3.9 in long-term. That seems pretty manageable for free cash flow of around probably 1.7 for the end of the year. doesn't sound terrible. I don't think they're going to have any issues there. So pretty good looking there. All right, jumping into shares outstanding. In December of 2016, they had about 846 million shares outstanding, down to 778.54 million shares outstanding. Difference of about 70 million, or about 8% of 8% of their shares were bought back in the period. So that overall, they've been going the right direction, not issuing new shares. And as we talked about earlier, with the new share repurchase of about 500 million, that's going to be another 4% of their current market cap if they're able to buy at today's prices. If prices dip down lower in Q4, that means they would be able to buy back a larger percentage. And remember, their total shares, total authorization on the share buyback is closer to $2.5 billion. And that, compared to their market cap, is about 20% of their shares outstanding, which is just would be amazing if they were able to do that. I don't think that's going to happen, in one quarter. It's probably going to happen over the next probably year or more. But it is really positive to see that shares outstanding is decreasing, and have plans to continue to do that moving on into the future. All right, next up I want to talk about oil prices, because they relate and definitely affect the price of Marathon Oil, because as oil prices change, upstream producers will either increase or lower their production. In the case of oil prices lowering, they typically lower their production, especially if it gets close to their cost basis on an oil basis. And if it drops below, they will stop production for a temporary time period until oil prices recover, or an oversupply goes away, or whatever is causing the issue. Now, with the pandemic, we saw oil drop all the way down to negative, and now it's when stabilized around 40 for a little bit, then went to 50, then 60, then 70, and now it's all the way up to $80 a share, or $80 a barrel. And the question you have to ask yourself is, where do we think oil prices are going to sit? Now, companies like Marathon, they were profitable at $50 a barrel, and so that's good. And they've been profitable for a little while. They've had probably like 4, 5, 6, 7 months of really tough times where oil prices were just really in the tank, and they were bleeding cash. And so right now, with oil being at 80, they're printing money. They're really, really happy. This is really good. So in my opinion, oil prices are going to be going up into the $100 range. There's a really good chance they're going to stabilize at a minimum at $70, but I think $100 oil is not too far away. People have even, hinted at $200 oil. I think that's far-fetched. At that point, there's going to be too much cheating with OPEC. And some things, and since I'm talking about OPEC, oil supply is definitely going to have an impact on this. And as oil prices continue to increase, inevitably someone starts cheating. And once one person starts cheating on how much they're producing, then it kind of opens the floodgate for supply. And we've seen this over and over again. Once someone starts cheating, and by cheating is going over what they say they're going to produce, and they've dropped more oil on the market, and then over time more people start cheating, and then you start seeing the supply starts increasing, and that's because everybody's producing more oil. And then finally what ends up happening is the price of oil drops back down, granted that demand stays stabilized. What we've seen over the last year is supply was decimated after several months, and no one wanted to produce oil at the oil prices they were at. And so moving forward, I think we're going to get to more of something that's normal. I think $70 oil is going to at least be here for some time into the future. I really do think $100 oil is possible, but I think at a bare minimum 70. So from a financial perspective, I think they're going to be very healthy, at least for the next 2 to 3 years. So that's good. All right, jumping into dividend information. Currently, if you buy MRO, you're going to get a 1.1% dividend yield. The total annual dividend yield right now is at 24 cents. That's 6 cents per quarter. There was a slight pause for most of 2020 or at least for 2 quarters in 2020. And they decreased the dividend from 5 cents to 3 cents when they did that. It only took them 4 quarters after reinstating to get back to where they were pre-pandemic, and they've already increased the dividend from where they were before the pandemic started. I do anticipate that this will start to increase. How much it increases to is more speculation. Back in like 2015, 2016, it was as high as 21 cents. I don't think they're going to get that high. I think they're going to focus mainly on buybacks. But if you are a dividend investor, this could be increasing. And if you were able to get in back, during the pandemic, your dividend yield could be as high as 4 or 5% right now. All right, for my final thoughts on Marathon, my price target is currently $19 to $20 a share. The upside from where it is pretty modest, and there is some fair risk associated with commodity prices. Now, Marathon has been able to deliver really good value, and they're back to where they were in 2019 in terms of revenue, and free cash flow looks to be quite strong, and their price to free cash flow estimated for the end of the year is going to be somewhere around 7, at least below 10. So price to free cash flow looks really great. In terms of how much they're going in share buybacks, I really like that. That's strong. Possibly over the next year, just returning 20% of decreasing value, shares outstanding by 20%. That alone would get you up to get us up to the price target of $19 to $20 a share. Now, again, I believe this price target could be higher, right? This is more conservative. That's just how I do it. There is a possibility that this stock runs all the way up to where it was in 2018 in the $40 range. There is a possibility that happens. A few things would need to continue to happen. One, oil prices need to continue to go up. You'll need to see these share buybacks continue. There will need to be continue buying and inflows into Marathon. And I think that trend has continued and it hasn't stopped. I think we'll have to, the financials are going to be what they are and they look really good. But I think a lot of this share price going to, if it does go to $40, the thing we'll have to pay attention to here is what momentum looks like. And so the momentum is really what's going to drive it up to $40 a share, in my opinion. On the strategy side of this is, for me personally, oil is not a long-term investment. I saw Marathon as well as other oil plays right at the beginning of the pandemic, and I said, this is where I want to invest a lot of my money because there was the OPEC issue, there was supply and demand issues, and these companies were on discount 75 to 50% easily across the board, and I went in heavily on Marathon. Was a great investment for me, as well as other ones. But the point is I don't see these as long-term investments. The good thing about where they are right now is I have a really low cost basis on them. I'm holding my oil plays until we start to see a slowdown or strong signs of a reversal in oil commodity prices. And as it relates to commodity prices in oil right now, I think we're still on track to see $100 oil and possibly a period of time where that goes up into the $120 range. Now, that alone we'll have to reevaluate and see. So right now, with Marathon specifically, this isn't true with any other of my investments or any other price targets that I typically give. If Marathon gets to the $19 to $20 range, I will more than likely hold, depending on how momentum is trading. If it's continued to look like there's more upside, I will probably continue to hold it. As that, $40 a share is significant upside, right? But for someone who's just entering this, if we see modest returns, I think for Marathon over the next 12 months, I think 19 to 20 is pretty conservative. So those are my thoughts on Marathon. I think right now they're looking very healthy. They've basically gone through a full recovery since the pandemic, and they look to be like a good investment for the short term. Oil's not a long-term investment for me just because they have a bad historical rate. We showed that through the price performance versus peers. And as these oil prices recover, I think, Pete, there's going to be a refocus on another industry for a time period of time. Right now, EVs are really hot. Before that, it was big tech, and still remains relatively pretty high and pricey. There's streaming that's really hot right now. But I think oil will go back to the back burner, and that's kind of why I don't think oil is a great longer-term investment, unless you're looking at dividends. That's a little bit of a different conversation. But those are my thoughts on Marathon Oil as an investment. Congrats to those who were able to buy near the over 2020. You got a really great deal, and you're probably really happy with this investment, as am I. Thank you so much for watching today's video. I do videos on personal finance, investing, and stock analysis such as this one. If you like this type of content, please consider subscribing. And also, if you found anything helpful, please, last chance, hit that thumbs up button. Thank you so much for watching. My name is Frank Finance, out.